When we look at what happened with CPI data today and we look at the reaction that we're having on the market, it continues to tell us that there is a disconnect as a whole. Now, when we look at CPI data, and if you looked at it today, I can guarantee when you looked at this, you looked at it and thought, oh, CPI was better than expected. It dropped. It wasn't really that bad. But as we dive into this, we have to ask the question, did it actually beat? See, when we look at CPI year over year, you can see, yeah, that is down 6% from 6.4%, 0.5 to 0.4. But when we take a look at core CPI, this number right here, it's staying flat, if not going up. For instance, core CPI was 5.6 last month. It came out 5.5. It was 0.4. It rose month over month to 0.5. Now, as we attack this is where we get a little bit more answers. And this is the big question. Now, this was reported earlier today, and it's worth mentioning. Bank of America says that today's February CPI report continues to illustrate the sticky inflation problem that the Fed is currently facing. Given the Fed's focus on core services, ex-housing services, which is what Powell said the entire time in front of Congress, the Senate, and the House. That's all he talked about was this right here, core CPI. Right? It will not be encouraged by core services, ex-rent, OER, owner's equivalent rent, advancing by 0.5% month over month in February. The economist says, B of A says that despite increased uncertainty from developments in the banking sector, the Fed needs to still do more to cool off the economy and labor market based on today's CPI. And when they talk about the labor market, they're talking about what happened with non-farm payrolls and everything last week. We did see the unemployment number tick up, but it was weird because we saw non-farm and everything else rise as well, ADP as well, right? Those all gained more traction, had more jobs there. That's worth mentioning here. Based on today's CPI, B of A continues to expect a 0.25 BP hike next week as the Fed continues to hike the terminal rate to 5.25 to 5.5 by June. Big statements here. Now, before we dive into this, what this means and everything that I'm looking at there, I have to ask you to do two things. Consider liking and subscribing, and that's all I'm going to say. If you don't get nothing out of this video, I recommend unsubscribing. Okay, I try to be as unbiased as possible every single day here. Now, going back to this data pool, this leads me to one more thing, and I want to take a little bit of a trip and look at some of the data here specifically. Now, this is posted on my Twitter, so you can go check this out. This is the CPI report from today, and it's a little bit, I'll zoom in just a little bit. Can I zoom in anymore? I don't even know. I don't think I can zoom in anymore. This is as good as it's gonna get. So you have to grab your screen, zoom in with me. Now, as we look at what's happening here, you can see January into February, okay? Now we can see everything in general here. Once again, where we see the drop occur is all in energy. Reason why core shows no movement and regular CPI shows movement. Going a little bit deeper, we can see a slight drop in meat and eggs, very, very slight, but everything else is sideways, if not going up further. The data's in front of you. I'm not lying. This is what it is. And this is what the Fed's going to be looking at. Because again, what was the main statement that we've been talking about? How can we expect rent prices to continue to drop if December through February is the time that typically rents are the cheapest nationwide? It's actually the opposite viewpoint. You have to anticipate rents to start rising into summer months. Again, inflation, I'm telling you, it's gone nowhere. This report tells you even more information, and that's why B of A said what they said. A little bit more. Zooming in, I can zoom out a little bit here. One more very important thing. Investors should stay wary of equities after the SVB woes. JP Morgan. Investors should stay cautious towards U.S. and European equities following the collapse of a U.S. tech lender, Silicon Valley Bank. It's very important how they rationalize and they talk about this. Now, it's interesting. All these banks came out a day ago and said that we're going to get rate cuts and all this good stuff was going to happen. Now we're flipping the tone here. Very interesting. It's almost like they don't have to be transparent. It's almost like we shouldn't be trusting these individuals in the first place. Following the events surrounding SVB, yields declined. We talked about this yesterday. We'll talk about it more today. Major market indices have moved lower and fixed income spreads have widened as investors have embarked on a flight to quality, JPM says. While fears of broader financial contagion are unwarranted, talking about SVB collapsing and then it's spreading to everyone that they loaned money to, i.e. Roku, etc., USDC, JPM is staying defensive in its global asset allocation. approach and increasing its underweight stance on equities, it says. Within U.S. equity strategy, we continue to believe second half of 2023 earnings expectations remain high bar for corporate to give clear, sticky labor cost. Rising cost of capital pressures and risk of demand slowing in the latter part of this year. What does this part mean? This right here, sticky labor cost. Once again, this is what Powell was talking about. Cost of labor, cost of services continue to rise. Why? Because wages are increasing. As wages increase, obviously the service to do said job increases as well. If I have to pay someone more to wash a car, obviously the company is going to charge more money to have that car washed by their employee because they need to make money. And as long as this can keep getting fulfilled, it will continue to stack and stack and stack. This is the definition of inflation. That is how it happens, okay? That is simple. Typically it happens slower, but it just keeps on stacking up because we just keep on paying people more. And they're finally attacking this issue. Then the bottom part, the risk of demand slowing in the latter part of this year. We are already seeing demand slow. We've already seen it with ISM manufacturing across the board. It's dropping rapidly. However, the necessities of what we have to pay for, we continue to pay at higher prices. And again, this is the cycle that we are currently in. That's the major issue. That's why some of these companies aren't reporting the greatest earnings, but most of the goods are staying the same price. You have to view the big picture of what's happening here. And that's the danger of where we're at. We haven't got to the charts yet. The last thing I want to mention is Carl Icahn says Powell has to increase interest rates sooner than later, and he is net short on the entire market. He has more short positions than he does long positions. Now we get to get to the good stuff. We get to get to the charts. What I will say before we attack these charts is I think there's a little bit of merit in some of the things that we've been discussing here. I think that it's not me just ranting. It's not me just screaming at you guys. It's me trying to really give you a warning sign of what's really happening out there, what big money is actually preparing to do. And it's interesting when we look at this that one day we can come out and say, oh, we look great. Nothing bad's going to happen. And then the next day, the same bank, JP Morgan, that said they're probably going to start cutting rates, that the Fed's going to start cutting rates. What do they say? They're reducing risk across the board. So they believe even though they're going to cut rates, they're going to pause rates, they start cutting them at the end of the year, that they shouldn't start exposing themselves to equities. Shouldn't it be the opposite way around if we really look at the fact? And I know some of you are going to say, well, Tyler told me cut rates in the past that we usually drop again. That's so far from the truth because we're totally disconnected from normal market conditions. We've never raised rates, from 0% to 5% nonstop without doing one cut or a pause. That's never happened before in history. Go look it up. So we need to identify what's happening there. If I'm wrong, I'll admit that I'm wrong, but I'm 90% sure. I'm 90% sure that I'm not wrong about that. So just food for thought. Now, what should we be looking at? What should we be worried about today as we go into tomorrow PPI? And I say to you, I don't believe CPI was good. I do not believe it for 1 second based on the numbers. As we look here, what's happening? You're bouncing on that 200 MA on the weekly from yesterday. Now, as we dive a little bit deeper, where are we bouncing at today? We zoom into the 4-hour here on the Nasdaq. We go to the daily. Oh, go figure. We're mounted on top of that daily 200 SMA as well. Still trying to push up. We're still making lower highs. As you can see here, clearly still making the lower highs, right? Lower highs, lower lows, still in the downtrend structure. But we're finding support where we expected to find that support. In my opinion, I do think we have some continued downside, but I'm not pressuring the downside play until we come out from the Fed. I think the Fed is the only thing that will solidify that position and their resilience of their position on the market. I think that's the most important factor going into this week and next week, okay? So we need to understand that. PPI, I expect it to be a little bit cooler than most likely CPI. So I don't expect PPI to beat. I don't think it's going to be super hot. I don't think it's going to be crazy, but I don't think it's going to point us in a direction that leads the Fed to pause rates unless it's just absolutely incredible, which I don't believe it will be based on job numbers, based on wage growth, based on CPI. I just can't imagine that PPI will come out fantastic. Personal opinion. Looking at ES, a little bit clearer here. ES points us in a very bearish tone. It points us in one of the most bearish tones in the entire market. You continue to hold below the 200 SMA daily, continually. When we look at SPY, you get a better visual here. We rejected there nearly all day long, continually rejecting at the 200 SMA 393. Can we break above this? I do think it's possible that we could have a little bit of upside into next week. I, for one, am not touching the upside here. I think the upside here for options is stupid. I think it's irrelevant. I think it's extremely risky. I'm not touching it. It's not financial advice. You always need to do your own DD. But for me, you will not catch me going long on the market here. Makes no sense for me. As we dive a little bit deeper, you can still see it looks very weak to me. Okay. One could even argue that you're forming a bear flag here on the ES. You could argue very easily that this is a bear flag on the 2-hour time frame, right into the 90 MA or the 200 SMA, and it looks like you're going to try to push back down. After we look here as well, you can see the weekly. We have not even touched it yet. You're very close. But again, like I said yesterday, if we start making new lows on ES, I believe no matter what, we're going to get hit. And it really comes back down to the Nasdaq, because I believe the Nasdaq is leading the market right now. It's also worth mentioning where we're at. What did we say? XLF has had a lot of pain. Okay, XLF has had a lot of pain. You're bouncing where you need to at the weekly 200 SMA. But I'm going to tell you right now, XLF has started to bleed. It started to feel a lot of this pain. If semiconductors, I'm going to continue to say this because when it happens, I'm going to bring it up and I'm going to show you guys. If semiconductors start to roll over, which they've remained very strong and resilient, today's especially, NVIDIA, AMD bouncing back to local highs. I will say, if these start to roll over, you will find immediate new lows on SPY. You have to understand that. It's my personal opinion, not financial advice. Do your own DD once again. But what I am watching is to see, can we continue to hold the higher lows that we were trying to make here? Okay, you're holding the trend. You look good. You look solid. But if you break down, I'm not going to like it. Not going to be a fan. It's going to be gross. You need to watch out for it. 200 SMA is also pretty, you got some distance for it. But again, semiconductors holding the strength, and I would argue are holding the Nasdaq in place and arguably the SPY as well. If we see that rollover happen, I'm telling you right now, again, be prepared for the downside. Now, before we go any further, looking at some of these, actually, you know what, one sec. One more thing when I look at is Bookmap. Bookmap, the link is down below if you want to check them out, giving us a better visual of what's happening with orders across the board. Now, we still have some time. The market actually closed 15 minutes ago. If we look here, I want to show, we do have time and volumes going to come back in, but I want to show you something. The blue line right here represents the hidden orders, dark pool coming in. It's stuff you're not going to see on the sheet, not on the tape or your level 2. As you look here, all day long, we did actually get a long right here, but you can see 90% of the orders that came in on the dark pool today, heavily in favor of the downside. Heavily in favor of the downside. All morning long when you're pushing up, downside. Now what happens here? You start dipping down, dipping down, dipping down. No one's buying any puts. You start bouncing back up. What happens? Buying the downside. They're shorting. I do not find this coincidental. A very big thing that we need to be looking at too. Look at what happens when you drop. It's the same thing every day. When you drop, there's no resistance. There's no walls. It's very quick. It's very simple. It's very easy. On the upside, look at how much of a battle it is. Continually. Wall, wall, wall. It's a slow grind. What does this tell us? The most resistance is on the way up as of right now. It continues to tell me the momentum is to the downside as of now. We saw what happens when you get good buying in the beginning of February, the end of January. We traded that the entire time. But right now, I believe this is a very dangerous game that people are playing, going long here and being very dangerous and irresponsible with a lot of their money. Now, as we dive a little bit deeper, I do want to show you something from a day or two ago. This is the AMD trade. And I only show trades going forward now to educate, right? To show risk to reward, and really to just show transparency with you guys, because I don't want people to ever think I'm lying about anything. This is our AMD trade. I mentioned it here on the channel. I mentioned it on Twitter as well. We got in about right here at 85.5. You can see this is where we entered, and we exited right here at around 16.6 a contract, 16.10 roughly, at around 80.4. We made that nice little drop. That's where the contracts went. About 4,500. It was actually a little bit more. I don't know why it's calculating so weird from Interactive Brokers. And then this is our running P&L. We were red for $230 for about 10 minutes, and then we were green the rest of the trade to the upside. So that's that trade. That's how it played out. I want to continue to show anything we talk about here. Any trades that I take personally, I'm going to try to show you as much as possible here as well, so you guys know. Now, going over trades I'm liking. What am I looking at going forward? What has my attention? Right now, my favorite trade, once again, Tesla. It's absolutely beautiful. Now, this is, I don't want to call this a head and shoulders because it's a little bit off. It's a little bit ugly. So you can see you have that type of shoulder, the head, and then arguably another shoulder forming out there. It's a little bit ugly, a little bit off, but again, it still looks fantastic. The price action though, as a whole, looks shockingly similar to what we saw back here. Very, very similar to that 314 rejection, how we topped off there, just like how we topped off here at 215, 220, and then you push down. Shoulder, shoulder, push down. Now, again, I'm not going to say it's a head and shoulders, but that's the price action of what it's looking like to me. What was said to me today is that it's looking somewhat like a cup and handle, which definitely looks interesting and definitely causes me to show a lot of concern here of the possibility of it pushing its an inverted cup and handle. But again, I still like the position. I started my position today near the end of the day. Got up around 12%, told everyone in Discord it's 12% risk into PPI. Close if you don't want that risk. But I'm still holding my position. I expect more downside. I'll have you guys updated in the near-term future. I grabbed May contracts for myself. Going forward as well, looking at VIX, I want to paint a little bit of a picture here as well. What do we say about VIX? If VIX holds in the $24 region, I continue to expect a bounce. You're holding in 23 to 24, very close to this range, okay? I think VIX is still in the danger zone, if you will, and I think there's still a high possibility you can shoot back up here on the VIX, especially with some of the volatility that's definitely been occurring here and the buying back of VIX. I'm going to show you the options chain here in a second also. Talking about those yields and what happened yesterday, we mentioned this was the sharpest decline in yields that we've had since 2020, which was the taper tantrum when they cut rates all the way down to zero, which justifies yields getting slammed. Okay. What happened today though? What happened yesterday? There was an expectation that yields were going to drop or that rates were going to get cut. They were going to pause. What happened though? Nothing. Nothing actually happened. When you look at the data of what's actually happening here, the Fed has no reason to pause the rates now, other than the fact that banks may have taken bad trades and they may have been irresponsible with their money, and the Fed has to risk inflation becoming entrenched because of these bad decisions. That doesn't sound like a reason for me to pause rates. As we saw today, what happened? An immediate bounce on the day from the 200 SMA as well on the daily, bouncing back up really aggressively as well, specifically on the 5 and the 2. The 10-year, 30-year getting a little bit of a bounce as well, but I'm going to tell you right now, the 2 and 5 are going to give us some of that direction, and I usually don't focus on those, but in the short term, I'm going to start focusing on these because I want to see if they're going to bounce back to 4 or 5% very quickly. If they do, then it signifies that this was a total fake out, in my opinion, which it's really looking like as of right now. Looking at TLT, very interesting. TLT really represents the health of our economy, in my opinion. It's a very good way to look at the health. Look at what's happening here. We topped out yesterday, like we said. We pushed down. Even though we got love on the market today, TLT got pain, showing us that maybe the market's not as healthy as we think. Again, very worrisome across the board. DXY still getting hit on the day, but that's going to happen with what's happening out there right now. Again, DXY, I do expect to still touch the 200 SMA, but based on what's happening, it's just going to be, DXY is going to be a slow mover until the rate decision, in my opinion. Once the rate decision comes out at 0.25, I think DXY shoots back up. Personal opinion, that's where I stand, and that's how I'm looking at it. Overall, favorite plays, Tesla remains my favorite possible play out there. If you're looking at banks in general, I still think KRE is the number one name. You had an opportunity to go short around 49 today. I still think these guys are the ones that have the most pain across the board. I think XLF will start to have more pain, but if you look at XLF, it's that massive level that we talked about, the 200 SMA on the weekly. It's a huge level, and you're finding a lot of support there. If you break below 31.8, I think you have a lot of room to drop, but right now that's what I'm going to be looking at. Wells Fargo still shows a lot of pain. Bear flag on the, I believe, weekly and the monthly. Absolutely disgusting. A lot of downside there. I think the names we have to be watching are going to be semiconductors, but I can't go short at the top here. It's just not logical because it's the strongest area of the market. I'm watching for shorts. I would love to get back into NVIDIA or AMD, but as of right now, I'm sitting on the sidelines waiting patiently. I'm going to wait for an opportunity just like we continue to do from the past. We've made a lot of money on AMD and NVIDIA. We want to wait. We want to be patient. Let the opportunities come to us. We do not want to jump out of our comfort zone and start risking money for no reason. We don't want to be playing the catch me if you can game. We want to make sure we're taking risk to reward opportunities that favor us 9 out of 10 times. That's what we're looking at here on the channel. That's the focus for me specifically and going forward. Last thing we'll talk about is going to be the options chain. VIX, still heavy call premiums coming in. You did have a put come in at $26. This was near the beginning of the morning, but as the day progressed, a lot of VIX calls still pumping in here. Looking at SPY, what happened here? Still the biggest orders of the day coming into puts. What I will say, big orders are now moving from April into May 19th. That's where I side with all of my positions right now, are going for May 19th. I love the day. And if you go look at the option chain, a lot of premiums are flowing in for the downside to May 19th. That's my favorite day right now for any options contracts. Looking at Qs, you had a little bit of calls coming in here. And it makes a little bit of sense because if we look at what's happening with the market, again, look at the disconnect here. If we look at ES, clearly in the downtrend, clearly. Looking at NQ, looks a little bit better. You're trying to hold up a little bit better, trying to get out of that. This is the actual downtrend that ES is in, but you can still see, I mean, obviously ES is in this nasty downtrend, but you can still see Nasdaq is holding much better, right? So if you're hedging an account, hedging a position, you would go long on Qs and probably short SPY, because SPY clearly has all the weakness right now because it's primarily held up by banks and semiconductors, which banks are obviously getting smacked the most right now. Again, a little bit deeper, going into SPX, you're seeing a little bit more calls than you were seeing. I'm going to tell you right now, seeing a little bit more calls. Option chains, it's a little bit on both sides here. But when we look at the longer data positions going into May, which again, May and June are where I'm watching it a lot right now, I think they're pointing a lot to the downside. That's where my focus has been. I continue to look for that downside, and I do believe it will be coming very soon. Again, any positions entering right now before the Fed minutes, I believe are pretty risky, or before the Fed meeting. So just be careful and be under the notion that you're going to have more risk going into trades before they release that data. Because right now the market's definitely pricing in the expectation of no rate hikes. I 100% believe they're going to raise rates, and I do think it's going to have a direct impact on the economy if they do so. Have a good one, traders.